the world compounds very fast. Banking as a whole has earned at rates that are well beyond on tangible equity, well beyond, I think, what much more glamorous businesses have earned in recent years.
Well, banking is a good business if you don't do dumb things on the asset side. I mean, basically. And it's a business that the banks we own the commercial banks earn between 12% and 16% or so on net tangible assets. That's a good business. It's a fantastic business against the long-term bond, at 2%. If you have a choice between a 2% instrument and a 12% instrument, which one's going to win over time? So if you ask me whether I think banks are going to go down where they only earn 3 or 4% on tangible assets, I don't think that'll happen.
I wanted to ask you to comment on the relative PE multiples of bank stock versus the S&P. They seem to be at 35 to 50-year relative lows to the S&P, and I was wondering if that's a result of a change in the market's perception of the forward growth rates of banks, or if the market has perceived that there's a change in risk.
You're asking about the performance of what group compared to the S&P?
Banks.
Banks? Well, and what was your assertion about the performance historically?
The relative multiple of bank stocks versus the S&P. Back in the 40s, 50s, 60s, they commonly traded at, say, 1 times an S&P multiple, and now they're maybe half that level.
Yeah, Harry Keefe used to have a lot of figures on this, and I don't really think about them. I mean, the appropriate multiple for a business relative to the S&P will depend on what you expect that business to achieve in terms of returns on equity and incremental returns on incremental equity versus that S&P. I mean, if you've got two types of businesses, and we'll say the S&P earns X on equity and can deploy an additional amount of capital at Y, and then you compare that with any other business, and that's how you determine which one is cheaper. I would not characterize all banks as the same. I mean, we have in this room John Forlines, who runs the Bank of Granite, North Carolina, and they've earned 2% on assets without taking any real risk for decades, and it's a tremendous record. And then you have other banks that have been run by people that took them right into the ground. I mean, whether it was First Pennsylvania going back 30 years ago, I think it was John Bunning, and they're not a homogeneous group. We own stock in a couple of banks. We own stock in M&T that has an exhibit downstairs today. We own stock in Wells Fargo, and we think those institutions are somewhat different than other businesses. So I don't think it goes back to that earlier question. People always want a formula. They go to the intelligent investor and they think, somewhere they're going to give me a little formula and then I can plug this in and then I'll make lots of money. And it really doesn't work that way. What you're trying to do is look at all the cash a business will produce between now and Judgment Day and discount it back at a rate that's appropriate and then buy it a lot cheaper than that. And whether the money comes from a bank, whether it comes from an internet company, or whether it comes from a brick company, the money all spends the same. Now, the question is, what are the economic characteristics of the internet company or the bank or the brick company that tell you how much cash they're going to generate over long periods in the future? And I would come to very different answers, on M&T Bank versus some other bank. So I wouldn't want to have a single yardstick or relative PE that I went by. I think that banks have sold, a good many banks have sold at very reasonable prices. We bought all of a bank in 1969. We bought a bank in Rockford, Illinois. Charlie and I went and we must have looked at a half a dozen banks, in a 2 or 3 year period.
Absolutely.
Yeah, we trudged around and we found some very oddball banks that we liked, and they were characterized by very little risk on the asset side and very cheap money on the deposit side. And even Charlie and I can understand that. And low prices, incidentally, too. And then they passed the Bank Holding Company Act in 1969, and they killed off our chances to do anything further in buying all of banks. So we look at banks. We will own bank stocks from time to time in the future. We'll probably buy stock in other banks. We've also seen all kinds of banks ruined. I think it was, what was the fellow, M.A. Shapiro, who came up with the statement. He said there are more banks than bankers. And if you think about that a bit, you'll see what I mean. There have been a lot of people that have run banks in a very injudicious manner, but that's made for opportunities for other people. A lot of banks have disappeared over time. I mean, up in Buffalo, where Bob Wilmers runs M&T, there were some other very prestigious institutions that went right down the tubes. And a lot of that happened in the early 90s or late 80s. I wouldn't look for a single metric like relative PEs to determine how to invest money. You really want to look for things you understand and where you think you can see out for a good many years in a general way as to the cash that can be generated from a business. And then if you can buy it at a cheap enough price compared to that cash, it doesn't make any difference what the name attached to the cash is. Charlie?
Yeah, I think the questioner is maybe even asking the wrong people that question. I would argue that Warren and I have failed to properly diagnose banking. I think we underestimated the general good results that would happen because we were so afraid of what non-bankers might do when they were in charge of banks.
There are a number of banks that over the last 5 or 6 years, on tangible net worth, a number of them have a lot of goodwill, but on tangible net worth have earned over 20% on equity. You would think that would be difficult for an industry to do, dealing in a commodity like money. And of course the bankers will argue it's not a commodity, but it's got a lot of commodity-like characteristics. And you would think those kind of returns in a world of 6% long-term interest rates and much lower, you'd think that would be very hard. You would have thought it wouldn't have occurred, and you think it'd be hard to sustain. We've been wrong in the sense that banks have earned a lot more money on tangible equity than Charlie and I would have thought possible. Now, I think to some extent they've done it because they stretched out equity much further than was the case 20 or 30 years ago. Yeah, they operate with more dollars working per dollar of equity than people thought was prudent 30 or 40 years ago. But however they've done it, a number of banks have earned very high returns on equity in recent years. And if you earn high enough returns on equity and you can keep employing more of that equity at the same rate, that's also difficult to do. The world compounds very fast. Banking as a whole has earned at rates that are well beyond, on tangible equity, well beyond, I think, what much more glamorous businesses have earned in recent years. Charlie, you have any?
I say again, we didn't diagnose it as it actually turned out. And even worse than that, we haven't changed.
And even worse than that, we won't.